Hello, fellow investors. I'm L.A. Little, a financial author, investor, trader, researcher, and the founder of Technical Analysis Today, TA Today for short. And after years of research, I have developed a model of the market that fulfills a lifelong dream to be able to tell when there is enough increased risk in the market to warrant greater caution and to reduce equity exposure. But before I get too far ahead of myself, let me ask you just 3 questions. First, are you saving for your retirement or are already in retirement and simply trying to manage those funds? Second, is your objective to grow the funds but to avoid large losses? And finally, are you frustrated with having to try and learn how the markets work, yet feel like you have no choice but to do so? If you answered yes to these questions, then realize there is a better way. TA Today has just introduced a service that's designed to keep you in the markets when the risk is low and reduce your exposure when the risk becomes elevated. To show you how that works, let me show you a chart. Here's a long-term chart of the S&P 500 going back to 28. And you can see that, yeah, it always goes up, right? Now, each of these blips down are huge. I mean, if you're looking at the 2008 crash or the 2000 crash on this time scale, it doesn't look like much. And most of the time, markets go up. In fact, about 66% of the time, markets are moving higher. The rest of the time, they're either going sideways or, at times, they go down. Now, it wouldn't be so bad if when they went down, they didn't go down very much. But each of those blips down that you saw on that long-term chart can be huge. For example, the 2000 crash was 50%, 60% on 2008. When they go down fast, and they can eat up your gains very quickly. So when you think about it in that perspective, what makes the most sense? Well, it's really just stay in the market as long as possible and only move to safety when the market structure suggests that there's increased risk. The problem, of course, is how do you know when there's increased risk? Now, I'll get to that in just a second, but if you think about the idea that you could recognize increased risk, then wouldn't the best policy be some sort of an insurance policy? Isn't that what we really need to know when risk is increased, more prevalent, so we can reduce our exposure? Well, I'm happy to tell you that there is a way, and we've packaged it now and call it the retirement service. It's your insurance policy to protect against potential catastrophic losses. It is what I have used over the last 6 to 7 years, allowed me to avoid the 2008 crash completely and actually make money. It's just that at this particular point, we've codified it to a process that we can now offer to you at a very deep discounted price, and I want to tell you about it because it's very affordable, just $6 a month for early adopters. So let me spend just a few minutes here to describe the process to you and how you can get started. On the Technical Analysis Today site, which is tatoday.com, you can pop in here to the retirement service. In this drop down, you can use it to tell you or to show you what these services look like. For example, if I hover over this, I can see how the service works, how to get started. I can actually see the portfolio links, email archives, performance archives. All of these available to you as a subscriber to this particular service. The way we communicate changes in risk is through portfolios, aggressive, balanced, conservative portfolios. You can see examples of them by clicking on the How Does the Service Work. Scroll down here, and these portfolio models that are here, you can click on them, and when you click on them, you'll be able to see the various portfolios, and these are examples of what they look like. They essentially tell you what ETF to be in, when we've entered that ETF, the trade type, which is long, the entry, expected initial targets, all that stuff, essentially how much it's gained or lost, and so forth. There's 3 portfolios because we all have different risk. There's aggressive, there's balanced, and there's conservative. So the more conservative, of course, is holding more bonds. The more aggressive is more equities, and the balance is a little bit more of a mix of both. Of course, the question you're probably asking is, how does it work? How does TA Today know when to reduce and when to increase risk? And it really is all about the research I've done. It has to do with market structure. Market structure that I've identified has always preceded these large sustained declines. It happened in 87, 2000, 2008. Those are the big ones everybody remembers. And you can read about it if you're interested over here on the site, again by clicking on this "How does the service work" button, scrolling down, and there's a bunch of articles I've written. They've been printed on Market Watch. They're dated back a year and a half ago or so, some of them more recent. And then there's a couple here that show you how we've called risk increase and decrease in the markets in a more recent way, just to show you how this market structure process actually works. Now, I wouldn't be honest if I didn't tell you that there's no certain thing in the market, right? There's very little in the way of certainty. The market isn't that easy. It requires some interpretation. And that's what I'm here for. The way I do this is I verify or I validate what is happening in the markets on a daily basis, and I'm looking at intermediate and long-term time frames, identifying the risk. And it depends on those different time frames, and it varies in different degrees. I interpret that, and then I feed that back to you through modifications to the portfolios. For example, if there's a little risk, the aggressive portfolio, which is more highly levered to equities, may see a change in it, whereas the balanced, the conservative, may see no change. If the structure is such that there's a lot of risk, then we may see changes to all the portfolios because the risk is significant to all of them. Via the portfolios on the site and email alerts to you, you'll always be synchronized with what I'm thinking in terms of risk, or market opportunity, and what you should be doing with your portfolio to position for gains or to position to avoid losses. So the obvious next question is, how do you get started? And to get started, it's pretty easy. You just pop back to the site, you come to the very top, Retirement Services, and you click on the Get Started button. That will bring you into a subscription page, have some thoughts up here about how it works and why it works, and of course an ability for you to subscribe to the service. But since this is a new service, and since I want to make it a success for both you and for TA Today, while we introduce the service, we're rewarding those who are willing to take a risk on me as being an early adopter and to give you some benefits and guarantees that we're not going to give folks later down the road. For example, we're going to greatly reduce the entry price. As you saw, it's only $75 per year. That's like $6 a month. Much less than you'll pay anywhere for anything like this. We're going to guarantee that rate for 5 years. No increases. Even though the price will increase for those adopting it later, there will be no increase for you as an early adopter. And there's also a one-time free consultation with me to help you position correctly and to fully understand what you need to do to stay on the right side of these markets. So for a limited period of time, I'm offering this early adoption process program that you can take advantage of. And the way you do it is you come to Technical Analysis Today, you click on the Get Started button underneath the retirement service. Once you're in there, you can subscribe. You get a free 1-week trial, gives you plenty of time to see what's there and to make a decision as to whether this is something that you want. Is it an insurance policy that you think is valuable? I believe that it's very valuable. It's based on all the research I've done, the writings I've made, and the extensive use of this over the last 6 to 7 years that has kept me on the right side of the market, and that I now make available to you as a passive long-term investor to manage and take care of your retirement. Thank you, and I hope to see you soon.